welcome to Killick & Co.'s podcast for the 16th of December. Turning to the week ahead, it's going to be quite an interesting week in the run-up to Christmas, in that the Fed will meet and discuss the conditions of the US economy, and a decision will be made on whether they begin the tapering process. The $85 billion stimulus package that is going into financial markets each month from the Fed, and will they start to scale that back? Still, the betting is that it will probably hold and move towards something early in 2014, but nevertheless there are enough out there who think that they may move earlier on that programme, and this has given markets a little bit of volatility, as I say, in the run-up to the end of 2013. A quick look at the diary. We've had some Chinese data out this morning already. This is obviously coming out overnight, which slightly missed the mark. Initially caused a little bit of weakness in Asian markets and also for European shares, which opened in the red, but they've pushed more positively as we have seen some data coming out from Europe on the European PMIs, which have broadly been positive, particularly out of Germany, but the French data that we saw was notably weak. So effectively, very much a two-speed economy developing between the two power blocks within Europe at the moment. Turning to the week ahead, well, inflation numbers are going to be of particular interest. UK inflation comes out tomorrow. The number we're looking for is around 2.2%. On the sort of year-on-year data for the UK, and also we'll be having numbers out from Europe and also the US. Both markets have been particularly or notably weak in terms of inflation data, so we'll be seeing sort of first and second readings coming out from those respective blocks. Finally, on Thursday, UK retail sales. It's all about the build-up to Christmas, notably whether or not we're seeing strong data coming out from the UK and how we're trailing ahead of Christmas. If you compare and contrast to this time last year, well, the weather is particularly warmer. So we had some exceptional conditions running out into Christmas last year, so it could cause some slightly stronger data, and that has been positive for sterling in the last few weeks. Results for corporates, well, Q2 from Nike will be interesting for us. That's one of our covered stock, part of our healthier living theme note. We have seen some interesting results out from Sports Direct at the end of last week, and a story concerning Adidas, which has been holding back some Chelsea stock and from the display on the Sports Direct stores, which could result in a bit of corporate activity, according to the Sunday Times over the weekend. Now, turning to some of the sort of notable movers, well, I mentioned about inflation data and also about what's going on within the Fed. The euro dollar is very close still towards those highs of the year, trading around $1.38. So currency markets could display some volatility this week. The betting still remains on the fact that the ECB will have to move more towards some form of second LTRO programs to re-stimulate certain aspects of the European economy. I was particularly taken by a story in the Financial Times last week talking about some of the sovereign debt that is being held by banks, and whether or not the ECB is going to take a more meaningful action against the banks in terms of their capital positions in sovereign risk. It's all really designed to try and sort of aid more money through the normal transmission systems of the banks, rather than just hoarding assets, but getting some more money back into the economies at the moment. So starting to penalise by holding, just say, some of the sovereign debt assets. So I think the ECB will be moving quite actively in 2014, where it needs to start to re-stimulate, as I say, some areas of the European economy. Turning to the UK, well, as I mentioned, we've got some interesting data, the retail sales numbers, also house prices. There'll be house price surveys due tomorrow. House prices have been generally moving higher. The indication is of a move of around 4%, so strengthening in terms of its sort of year-on-year comparatives at the moment. Indeed, Rightmove this morning have given a forecast for 2014 heading more towards 8% growth next year. So we've seen the Bank of England step back from its funding for lending scheme because they can see prices moving in the right direction at the moment, and caution against some overheating within that sector. But all of this is indicative of slight tightening with the Bank of England policies. That's been good for sterling, and as you can see, sterling sort of still remaining against the euro towards the top end of its range, and particularly against the dollar that we've seen. Now, Footsie, in terms of the FTSE 100, we have seen a sell-off in December, quite a notable sell-off of stocks since that period. So far, month to date, it's off around just over 3%, which is in comparison to, say, the US market, it's about twice the sort of drawdown that we've seen against US markets, and in Europe it's actually slightly worse. So December is on track at the moment to post its first negative performance seen for at least a decade. So quite a surprise for markets to be going into the year end quite weak, but to some extent the preserving and hedging and protecting sort of gains seen so far, I think, is at play in these lower volume markets. But certainly we've seen the weakness there. The S&P, this shows the sort of performance over the course of the last few weeks. So it's been proving to be a much more resilient performer over time. Just turning to a couple of stocks. Last week we saw a guidance lower from Imagination Technologies, which was one of our stocks for 2013. Been a disappointing year for the company, and it wasn't helped by lowering their royalty rates. We did meet with the company on Friday and actually interviewed the chief executive for and we'll be publishing that video recently. We retain a strong hold on the business on the basis that we know that the business is investing heavily on operating expenses and has been hit by lower royalties and also lower licence fees this year than planned, but we see it as operationally geared towards the upside in terms of the recovery of licensing and also for royalty rates coming through over the course of the next 12 to 18 months. So under separate guise, we'll have a video there with the chief executive. In terms of a new recommendation that we're looking at for 2014, Church and Dwight makes it onto our list. Church and Dwight is a US company, has power brands in the consumer space. These are the sort of items, the day-to-day items that consumers will buy in terms of washing powders and personal care. So equivalent businesses that you would find over here would be the Reckitt Benckiser's. The company trades on 21 times earnings. That's a very sort of modest premium to the sector average, but we see it displaying faster growth. It operates very much at the economy level of the marketplace, and notably we have seen sort of changing trends within the US, to some extent here in the UK as well. You've seen the Lidls of this world and the Aldis taking market share off of Tesco's, and that is definitely happening more aggressively in the US, and so we're picking up the brands that are exploiting those particular trends, and therefore that modest premium we think is worth paying for Church and Dwight as a business. In what is a consumer staple part of the market. Finally, just want to mention that this is the last weekly podcast for 2013. You will hear from us with our predictions video, and that's going to be published very shortly in the next few days. For looking ahead to 2014, we'll be picking out some of the sectors and themes that we think will play quite strongly, giving you a FTSE 100 forecast, and also picking out 10 stocks that make it onto our 10 for 2014. And in the meantime, wish you all a very Merry Christmas, Happy New Year, and we'll be back early in 2014 with the renewal of our weekly podcast.